So don't lose sight of that. But one space that has been doing pretty well is real estate. Brigade Enterprises is in focus. The company reported decent Q3 numbers. The sales value gained by 56% year on year and the realization surged by 36%. The stock has gained 100% in the last 1 year. To discuss the demand trends, we have Pavitra Shankar, the MD of Brigade Enterprises, who joins us now. Pavitra, always great speaking to you on the channel, and thank you for taking the time out. I wanted to start by understanding what Q4 is looking like so far. What kind of traction are you seeing? And, what's the outlook on bookings by the end of FY24? Where do you think the company will be?
Hi, good morning. Thanks for having me. Traction is looking really great. We launched a large project at the end of last quarter, 2 million square feet that was doing really well. Actually, we launched almost 2.7 million square feet last year. We are on track to launch another 2.5 or so this quarter. And I think we are going to show some pretty good numbers by the end of this quarter. While we are not going to be able to give guidance, I think the trend on ground is very good demand from end users as well as investors in apartments as well as plotted projects across our target markets of Bangalore, Chennai and Hyderabad. So it makes us confident that we can continue to invest in land and look at new projects and continue to put our launches as quickly out there as possible. I think the market is looking very good for the short to medium term, and we should take as much advantage of it as possible right now.
Are you going to take advantage of the upbeat market with further increases in pricing or realization improvement? Your 9-month realization for residential is up 36% and is now close to 9,000 rupees per square feet. In FY25, for instance,
Yeah, so the realization is a combination of the projects that we've just launched. So the project that we launched last quarter was at a substantially higher price realization than some of the portfolio that was on that is currently being marketed. So therefore, it showed a higher realization. And every quarter that will be the case. So this quarter, as we're launching a plotted project, we may see a slight dip in those numbers. So it's very reflective overall of the quarter launches that have happened. But that said, if I look at a 9-month comparison to the prior financial year, we still see a 20% increase. And I think that's reflective of the overall sentiment for the real estate segment. While Brigade per se has also increased pricing, I think it is reflective of the market as a whole in the residential sector. And I would say Bangalore is a huge part of that. Bangalore, up to a couple of years ago, I would say you could very easily find something between 6,000 to 6,500 rupees a foot, which in my mind was completely undervalued as a market. So given where the city stands in terms of an economy and an employment center. So I think there's a correction there for Bangalore that was long overdue. But in general, the residential market is extremely healthy and allowing us to take up pricing. That said, in future, I don't know if we can continue to expect, 20 to 30% increases. Those are pretty hefty.
Pavitra, hi, good morning. One of the things I've heard from sort of relatives and a lot of family in Bangalore is that the new houses have all become not Brigade but otherwise generally houses have all become smaller, but the rates have all gone up. That's kind of a
actually. On average, I think houses have also gone up larger in terms of floor plans, and demand from customers tends to be looking for that extra bedroom, which is still, I think, the effect post-COVID. And even in our portfolio, we seem to be launching slightly larger units. So that's anecdotal, maybe. I think overall unit sizes are increasing.
I think that's the case not just with Bangalore, right? Throughout the country. That's a big problem we're facing in metros. But talking about metros, a lot of your peers have now entered the Mumbai market, and there's so much happening in Mumbai with the connectivity going up, with the Trans Harbour Link, the Mumbai Metro, Coastal Road, etc. At any point, either in this financial year or next, would you look to enter Mumbai?
No, definitely not. Plan is to continue our focus on Bangalore, Chennai and Hyderabad. I think over the last 2 years, we've added significantly to our Chennai land bank, and that's a market we feel very confident about. Although we do feel it is looked by many in the segment. So I think Chennai is a stronghold for us. Hyderabad also is an area of focus. Our strategy is that these three markets can afford us as much growth as Bangalore. And that, is something that we want to focus on, not just from a residential perspective, but also office, retail, and hotel. Since we are a multi-domain company, the same investment that we make in land banks, in partnering with landowners, with licensing, and so on, it's important for us to make use of those networks that we're doing and go deeper into the markets rather than do multiple projects or maybe one-off projects across different markets. But that said, that's all naturally Mumbai, NCR, these are all very large markets. It's something we will always keep an eye on, but in the short to near term and actually medium term, our focus is to remain in the south.
What about hospitality? Despite Q3 being a seasonally strong quarter, a pickup in your occupancy to 73%, the top line growth has been in single digits, 8%. Going ahead, do you think hospitality, you could look at it, the hospitality segment could see a double-digit revenue growth?
Yeah, we are pushing on that front. I think it's always a balance of ARRs as well as occupancy. The hotel segment has done well. Hospitality, if I look at a year-over-year performance, it has done extremely well. So it could just be a bit of seasonality and specific reasons why. But we're very confident about the hotel segment as well. I think the amount of domestic travel that is really supporting all of our business hotels is excellent. We are also planning to invest further in the hotel sector. Currently we have just under 1,500 keys under operation, and we are looking to add another 1,000 keys to that over the next 18 to 24 months.
Okay, so you're adding another 1,000 keys to your hotel segment, and currently you have 1,500 keys under operation. Got that. Will there be any fresh investments that you're looking to make, any kind of debt that you'd want to take on for this kind of expansion that you're looking at, both in the hotel as well as in the residential space?
Yeah, so in the residential sector, so far, we've not really required to take on debt. Instead, we've been paying off the residential debt. Today, we're pretty much at a zero debt level for the residential sector. On the hotel sector and I guess office, like anytime you're investing into these longer term assets that have a longer life where you're leasing up and operating them, we are going to need to use debt for that. And we're comfortable at the debt levels that we are today. We will also use a mix of internal accruals from the cash that is getting thrown off from the residential sector. So as of today, our debt equity ratio is 0.69, and we're quite comfortable at the level of debt that we have, also knowing that we will need to take on more debt to support the growth of the portfolio. But we have always done that in a fairly conservative way. Even our the interest rates that we pay have gone up naturally along with the repo rate, but have not grown as much as others have seen. So I think overall we have a pretty conservative approach towards debt, recognizing that you need it for growth, but also taking it in the right way.
All right, Pavitra, we'll leave it there. Great conversation as always, and good to hear you on CNBC TV18. Thank you very much for joining us. Good luck. We'll take a very quick commercial break here. We are going to be joined by the CFO.